Don't rely on experts. The biggest lesson I've learned in 20 years of stock market investing is this. A normal person who, like everyone else, uses only 3% of their brain can pick profitable stocks better than the experts. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. During this time, the fund outperformed the S&P 500 in 11 out of 13 years. It achieved an average annual return of over 29%, beating the markets by a wide margin. So what criteria did Lynch use to find stocks that increased tenfold? What were his buying strategies? Which stocks did he like and buy more of? Despite all economic downturns, there are always great opportunities to make money. Will you follow the herd mentality, or will you choose your own path? The luckiest investors in the stock market are those who lose when they first enter. Why? Because the money they initially invest is usually small, allowing them to experience downturns with minimal losses. However, those who win consistently at the beginning tend to take bigger risks over time. Eventually, their losses hurt more. Continuous growth is impossible. When the river rises, ducks think their movement is causing it. But true strength is revealed when the waters recede. For this reason, I strongly advise against trading blindly out of greed or based on hearsay. And an important disclaimer, this video does not contain financial advice. It's crucial to do your own research. Let's set emotions aside and analyze situations with logic and knowledge. So what should I do? Instead of focusing on the index, we should concentrate on the stocks we plan to buy. That's why we should listen to Peter Lynch. It's entirely possible to find investment opportunities that can multiply your money tenfold or more. Achieving this requires some diligence and sufficient research. The famous investor coined the term 10-bagger to describe stocks that increase in value tenfold. You can discover these opportunities at work, at home, or even while shopping. You just need to pay attention. Peter Lynch says outperforming stock market experts isn't that difficult. In fact, he argues that being an amateur is an advantage. Why? Because stock market experts have restrictions due to certain rules and regulations. They can't invest in specific industries, or they're encouraged to invest in certain companies. These limitations often prevent them from spotting or investing in stocks with massive potential. Due to these restrictions, experts can't focus on a stock until it has already proven to be profitable. By the time a stock catches the attention of experts, its rapid growth phase is often over. However, amateur investors don't have these constraints. That said, this doesn't mean you should invest right away. Before taking action, you need to consider 3 factors to determine if you're in a position to invest. Home ownership. Buying a house is an investment, much like investing in stocks. For example, you need to assess whether the house is in good condition, just like you would research stocks. Money you can afford to lose. You shouldn't invest money you'll need in the near future, such as funds set aside for your child's education. Investor personality. Are you patient, determined, and adaptable? Can you conduct your own research and admit your mistakes? How often do great investment opportunities appear? Most people come across 2 or 3 major investment opportunities per year. You have 2 advantages when it comes to identifying these opportunities. Industry knowledge. If you work in a particular sector, you have an edge in recognizing increasing demand for a product. Being a consumer. You witness new products and companies gaining popularity. For example, Peter Lynch invested in Apple stock after buying computers for his kids and noticing Apple machines in his office building. By keeping an eye on promising companies, you can buy stocks early and benefit from their growth. However, before investing your hard-earned money, ensure your predictions will truly impact the company's profits. How should companies be categorized? Lynch categorizes companies into different groups. Some companies grow at a rate of 2% to 4% annually, while others expand at 20% to 25% per year. True 10-bagger stocks, those that increase tenfold, are usually found among high-growth companies. Lynch does not include slow-growing companies, 2 to 4% growth, in his portfolio. If a company isn't progressing rapidly, expecting its stock price to rise is pointless. The stocks that yield the highest returns belong to fast-growing companies. That's where your focus should be. These are usually small, agile, and innovative startups with an annual growth rate of 20 to 25%. If you choose wisely, stocks in this category can increase your investment by up to 40 times. What should you consider when buying and selling stocks? Some investors sell stocks that have gained value and hold on to losing stocks. This is like cutting flowers while watering weeds. However, there's a nuance to consider. A stock's price may drop, but the company itself might still be profitable. If the stock price declines, but the company's fundamentals remain strong, this could be an opportunity to buy more. On the other hand, if a company is struggling with no signs of recovery, it's wise to sell the stock and invest in a more promising company. Lynch does not believe in technical analysis. The idea that this stock has dropped so much it can't go any lower is flawed. Trying to predict where a falling stock will stop is like trying to catch a falling knife. It's better to wait until it hits the ground and stabilizes. Conclusion. Before investing in a company, ask yourself these questions. Why do I want to invest in this company? What does it need to succeed? What are the obstacles in its path? If you can explain all of this in 2 minutes or less, either to yourself or someone else, it means you truly understand the company and are ready to invest.